Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, September 27th, 2023. It is 10:54 a.m. Eastern Times. I'm starting the video and just want to get out kind of the important stuff. Yesterday was a pretty long one. Let me just do a brief update here and kind of a follow-up to what I just got out to with Apple at support now. QQQ is just starting to crack it, but we're still clinging on by the skin of our teeth, if you will, to the divergences that they have. Apple almost always, at most points in time at least, the charts of Apple are going to marry the charts of QQQ due to the heavy weighting that it has in the index. And it's also just a tech index. So Apple, Microsoft, Alphabet, NVIDIA, Meta, they all move up and down together more or less, especially the bigger trends. So therefore, those charts also tend to mirror. But so that's it. So we have that. We're at support or a hair below. And as I said in this morning's post, I think that, the odds are favorable. I'm not crazy high. Nothing's changed since my updates yesterday. A lot of yellow flags still, even some red flags in the market. And one of those being, I'm going to get to in a second here, is oil. So let me say this in the simplest terms because I know and I get these comments, and I told you this morning I think the odds are favorable per bounce. Favorable means over 50%. Good means, whatever that number is, 60, 70, and great means, 80+%. So favorable just means if I had to flip a coin, I would say that we bounce today. And depending on how the employment and GDP reports go tomorrow morning, should we hold these supports? And even, I'll be honest with you, even better if you undercut, if Apple and everything undercuts, like I talked about it yesterday, it is, to me, to be expected not to come and hit a perfect, test of those levels, but to actually undercut. It's what the powers that be of the market do, market makers, algos. They know where the stops are, so it's more efficient if they can do it, bring down, clear out the stops, suck in some more shorts, and then reverse it. So now, with that being said, again, there are a lot of, have been for a while, a lot of yellow flags building, even some what I consider to be red flags now waving. And one of those, the two biggest really, let's forget about all the potential shoes that can drop. Financial, banks, non-bank financials, municipal bond market, pension, the pension funds, things like that. That's all out there. But the two biggest and directly tangible, we can measure it minute by minute, tick by tick. You don't know what's going on in CalPERS till they report well after the quarter's over. Muni markets, yeah, you can look at that, bond prices on the bond ETFs. But the two most important things right now that are either going to make or break, this support level and either give us a rally off support here on Apple and everything I'm going to get to in a second, all those big fangs. I already gave you potential bounce targets, or just slice right on through there, as I said, is very possible. That is number one, oil. Let's go to that. Yesterday I told you, there's a potential here. I give you a downtrend line. So if you pop that downtrend line, you're probably going to spike up. And then I could, see the potential. I said, look, we could see a blow off top in crude. And that seems to be what's going on now. If you follow things, if you follow the energy markets, OPEC plus, which is OPEC plus, right? And Russia's in there now. They're holding all the the purse strings. We're this Biden's big green plan to get off fossil fuels has cut down production in the U.S. So they've Russia and Saudi Arabia and OPEC members have cut production. They're really controlling the oil price more so than they used to. We used to be able to ramp up our production, and there's just not the incentives to big oil right now to do that. They're not investing in the infrastructure anymore because everything's, Washington's pushing us towards electric energy. So anyways, and away from fossil fuels. So that's what's going on. And why I'm talking about it is, as I've said many times, it is the single biggest driver of inflation right here. This is it. Everything comes down to crude oil, the gas you put in your car, the electric bill when you turn on the light switch, the package you just got from Amazon had to be brought to your house in a truck that burned gas to get there, or plugged in if it's one of those new hybrids they've got, and then of course that ran up their electric bill. And it's all energy, and the plastic wrapping it was in is petroleum based, and probably most of what the product was, or a good part of it. So all right, so everything comes back down to oil, or a lot of things do. And it's just in a stock market that already had one of the worst years in many years last year, due to soaring crude oil prices, among other things. This is unsustainable, as I've said, and same thing with interest rates. So these are the two big things, and this is going to make or break it. Now, as I said, I thought if we, I'd still do get a marginal new high. It's been a heck of a run up in crude. You can see big divergences building. You got to be careful with blow off tops, because they can, go beyond where most people think. You get a lot of shorts that start to get squeezed out. FOMO buyers coming in. And but that's it. So that trend line's been taken out, and that gave us this pop here. I think you can see it. Marginal new high. It is a divergent high. I do think we're going to go down in crude oil. But if we don't, that's what I'm trying to tell you. These are the things we're watching. If we don't, that can just crush the market, and it will. Just like I was saying months ago with treasury yields, I said, watch this. There's it's a point where the markets will begin to become hypersensitive to every little tick higher in rates. And I said that point will be, when we were back here, when we get up there and start testing the previous highs. Let me give you my clean board. And that's what we did. There's your previous highs. That's when the stock market bottomed in mid-October. And we tested it, got rejected, a little reprieve, stock market like that, but we went right back up there, and then we broke out. So like crude, we have negative divergence. I'll tell you, I was glad to tell you what I do. I reversed today when I got that post out to an Apple, because I expect a bounce. I don't want to ride out and feel any pain, get back, book some profits on shorts. I'm long for the day, and will almost certainly lighten up if we get a bounce or don't. I'm either going to be stopped out on that trade, or I'll get a bounce today, and I will lighten up because there's no reason to go crazy long. And what I'll usually do is, if I decide to remain long, let's just say we have a big reversal today off these support levels, I'll have stops. I'll decide if I want to reduce, how much to reduce, but no matter what, on my entire position, I'll have some stops set just in case the market were to tank and reverse, assuming that I go home long and stay long until tomorrow morning. I might get up before, the reports don't come out till 8:30, so I'll assess things at the time. And again, this is just the realm of an active trader, which is what I am. So all right, so that's it. So these two things, guys, this and this, if this continues or even remains elevated, then I think a breakdown of these support levels, which I'm about to go over with you. I told you that's not just Apple. I just showed you QQQ. I'll go over some of the other ones. If this continues higher and crude continues higher, or one or the other, then it will be very, very difficult to imagine a substantial rally in the stock market, especially that marginal new high scenario, which we still haven't been able to really knock down to the lowest odds yet, because we need to get those breakdowns. So these are the things to watch. Again, I gave you setups in the bonds yesterday. I went out to you today if you want to trade futures. This is that's the 60-minute chart of IEF. So there's bullish divergences, positive divergences. I'm giving you now the case for a rally in bonds, and I also mentioned earlier I'm viewing this as both a pure play. To be long the 10 or even 30 year if you want a little more juice. I'm kind of focused on the 10 right now. I look at it as somewhat of a hedge, because if the stock market just melts down, we'll probably see a flight to safety bid into treasuries somewhat to a lesser or greater extent, and should get a rally there. The technicals indicate it. Well, actually, it's no longer for me a hedge. It was this morning when I first got that post out to you, but then I decided to reverse. So I'm actually long both at the moment. So anyways, that's IEF, and I already gave you ZN, Zebra Nancy. That's the futures. That's the chart I got out to this morning. So those are the things I'm watching. Probably the single two most important things, that we can track minute by minute, tick by tick, and that is it. There's the crude oil, and it just continues to really push up. And again, it's going to have an increasingly negative impact on the markets. Again, I don't have to sit here and tell you how important that is. If crude, if we see $100 barrel crude, we're already in the 90s. Crude right now, futures are at 93.44. That's the price per barrel. The West Texas Intermediate crude futures, and it's still no signs of reversing. So watch, and if we get an abatement, especially if it's a pretty good pullback, and we start to get these divergences. Remember, these divergences are not confirmed. I use all this kind of quirky terminology I've made up, but this is what I call potential divergence. Why? Because it's a momentum indicator. In the PPO, the momentum, and the RSI, they're pointing higher. And until they reverse, they could go higher and take these divergences out, take out those previous highs, and you no longer have divergence. So I like to see that bearish PPO crossover and the RSI roll back down and effectively put in lower highs, lower below these previous highs. Okay, those are the things I'm watching, and so therefore, I'm, like I said yesterday, you got to be ready to, and in short notice to adjust, adapt. And right now, despite the indexes being down, we're right back to where I reversed. So here it is. Here's QQQ. Here's a 1 minute chart, 1 or 5 minute chart. There's that's where I reverse, and we're right about there now. And again, I'm not super uber bullish or super uber heavy. In fact, it's a very a counter trend trade. Like I'm going long, and despite being intermediate and longer term bearish, I'm just looking here. Let me get to it. Let me just show you. All right, so here's Apple. And Apple is at T2, which I added on. I made that officially resequence these targets. I had it added as support back on August 17th. And then on September 22nd, I said that would be now the second target. So this is how this trade is played out. And this was been highlighted for a long time. Broke down pre-earnings, had a little rally, a little blow off top. Big divergent high there, back tested, rolled over, went down. This was T1 right here, hit right. Let me try to get a little closer there. T1 was hit right here, went on down there, put in a divergent low, at which point right off the lows, I posted covering shorts and going long for a bounce, and I gave you two targets, 1, 2, both of those hit. And then as we were getting close to T2, I said, look, I could see a max potential rally up to backfill that gap right there. About 190.50, and that's what happened, and that was it. So that would have been an objective short re-entry if you didn't re-enter back at T2, and there it is. So this was a little mini support shelf I gave you the other day in one of the videos right here, and I said when that gets taken out, that should be the catalyst to go down to T2, and it was. You see a red candle, we broke it yesterday, hit. Now here's Apple. So I gave it to you at T2 today, which was price support 170.52, but we're also at that 200-day EMA. And again, no guarantees, but from my experience, the machines, the algos, computerized trading programs, as well as human beings are going to step in and buy pullbacks to the 200-day, the initial pullbacks. And if it's not the 200 exponential, it may be the 200 simple. Sometimes you slice through intraday only to close back above it. But either way, it's just a confluence of support. That's it. What else can I say? Support and potential divergences on Apple right there. Indicators still pointing lower, but making higher highs. So look, so that's it. So, and I'm near term bullish, looking for a bounce at least today, at minimum, a reflective bounce off here. Could certainly pan out for more. I'm going to draw a little trend line now. We have a little trend line right here. forming, coming down off the highs. So if they pop that, that might give us a bounce. Here's a 60-minute chart right here of Apple. Nice 60-minute divergence as well, positive divergence. And, you can see all these little divergent highs I have drawn here. This was divergence, building, bigger divergence. That was a divergent high right there. And that was followed with this drop. That drop ended with this divergent low right here, and that was followed by that rally. That rally ended with this divergent high right here, and that gave you that. All right, guys, let's not overthink it. That's why I'm long. All right, and not only Apple, Microsoft, also at support. A lot of these support levels I've been harping on for weeks, if not months now. These August 18th lows, and also some reactions in there as well. Also with positive divergence. And this positive divergence, mind you, can be the potential for that marginal new high scenario, because I have not ruled that out yet. It's still certainly on the table. The odds have been ticked down recently with what's going on, but I watch, and there's a lot of stuff I'm watching. I'm watching all those things to watch today that I follow. ADP, paychecks. I'll get to those in a second. The muni bond market, home builders. So either way, I covered a lot of short stay, even in the swing accounts, by the way, guys. I just want to let you know as well there. Usually I say I'll do something in the active trading account, but this is just too good of support and too good of divergences. If it breaks down, you know what? I'm going to lose a little by getting out of those shorts and then having to jump, deciding if and when to jump back in. But right now, charts tell me to be long at this very moment. So there it is, positive, aka bullish divergence potential on Microsoft. It will need to reverse soon and turn the indicators back up, get your bullish crossover. And then again, we have the potential for more. There's a little downtrend line right there. You could see that on the 60 if you want. Oh, there it is. I already had it drawn on the 60. So pop, 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 pop. Probably get a little short covering rally. Could be pretty nice pop today if we get this reversal. Alphabet. It's the story here. These are big levels. Let me go to a line tool here. This is a big support level, in my opinion. It was the top of this trading range. And I've talked about these. I talk about these stocks at least 2-3 times a week. I update these. Resistance. So resistance. Resistance once broken becomes support. There was your breakout, big gap up. Nothing more bullish than a gap up breakout. That's even better than a running up and then popping it. That's powerful. Just burns those shorts, traps them in, sucks in a lot of new longs. There's a breakout to new highs. Back tested, successful back test. It just makes that very significant support. Now it goes both ways. It's a solid support level. So if it breaks, that's a quite powerful, very powerful sell signal. And like I said, the redder the better. Maybe an intraday brief dip through there, or even a one-day close followed by a reversal. And so you can do it mechanically if you want. Take a breakdown on face value, but do what I'm doing. Look at all these collectively. I wouldn't just look at if you wanted to trade Alphabet only. I would not short Alphabet on a breaker 127.15 unless you see Apple, Microsoft, and Amazon, Nvidia, and Tesla, or at least the majority of those also breaking down. And you can make a good reason to be short on QQQ and SPY as well. So as I got out to you this morning, to me, I still believe these levels will go. I still believe they will go relatively soon. That could be today, tomorrow, next week. Or I think at most right now, get a little bounce, maybe go to backfill those gaps from last week. And there's the potential for more, but based on the scope of these big divergences, I do think there's a lot more downside coming. And I think that those divergences on Apple and everything I've been talking about might start to play out for a rally, and then that rally may get sold into. So I'm just looking right now. I'll be honest, I'm just looking minute by minute, tick by tick, and I may have, and I'll try to communicate my thoughts. I may flip back to short by the time this video is over, or by the end of the day. We'll see what happens. Again, I'm just pointing out multiple key stocks at support, and it's very hard. At the very least, even though we had some pretty powerful sell signals recently, and I do believe we're going lower, it's not very objective to short here because too many key stocks are at or just above support. In the case of Alphabet, we kissed it perfectly yesterday. And remember, these aren't just lines I just threw in here today. These were lines that I've created. This one was created back on August 7th. And what is that? 2 months ago almost. And we hit it yesterday to the button. The low was 127.22 versus my line at 127.15. So, all right, so that's it, guys. Amazon, this is the messiest of all charts. There was that support we were on yesterday. We're a little bit below it. And again, that's why you take it collectively. You're not going to get each and every of all Magnificent Seven stocks exactly at key supports at the same time. It's proximity is what you're looking for. Are the majority at or above support? Or have the majority broken below support? Especially after, I usually like to see that initial reaction. Again, we came close in Apple, and that's why I'm kind of meh. Maybe that was close enough, and that's where, we caught it. We got it right there at the lows, covered shorts, went long, played those bounces on the other board. I gave you the targets. So maybe that counts if it's close enough as the initial reaction off that support level, and we could go on slice through it. So the easiest way for me to describe how I'm trading, like I said yesterday, I'm driving with one foot on the accelerator, and at this point, at this very moment, it's long instead of short, with the other foot hovering just above the brake. We're ready to flip it in reverse and go the other way. All right, so there's Alphabet. I already covered. Amazon I covered. And the same story when you go down to these 60-minute charts. You've got a lot of these stocks. They have bullish divergence not only in the daily but also on the 60-minute charts. So that's something to take note of. And like I said, it's if we didn't. One more way to say this. If we weren't coming off these massive, big, just fresh off these divergent highs and fresh off some pretty solid sell signals on the daily chart, I would be long, like all in heavy, aggressively long right now, especially with the trend, the intermediate trend really from early in the year being bullish. So I'm a little, I'm tempering that the near-term bullishness. It's not, in other words, it's not an aggressive all-in moment. Plus, you got the big market moving reports tomorrow. There's going to be some volatility today and especially tomorrow. So we'll pick it up after those reports in the morning. Let me show you a few more, and we'll wrap it up. Get the video out to you guys. NVIDIA, again, another one right a hair above key support, about 403.30. There's another downtrend line. So this is a common theme. If you guys are interested in what I'm seeing, replicate these charts. Draw these near-term downtrend lines on the market-leading big tech stocks. Have the support levels below, near a breakout above. Again, barring any failure afterwards, let's just take it on face value. If the breakout fails, and then you adjust accordingly. But that would be bullish, and could give us. Potentially could give us that marginal new high scenario, but this one doesn't have any divergence on the daily. What you do have for NVIDIA, if you want to give it a bullish check mark or potential, see that purple line I have right here on the PPO? It's just below the zero line. It's at, if you want to replicate it, at negative 2.34. That is the delineation between bull and bear trends. What I'm looking at is I use that signal line, the 9 EMA on the PPO. It's the last of the two to cross. And when you're below, the trend is bearish. You made a bearish cross right here, and you went down. Then you made a bullish cross here, and you got this rally. You cross back down here. You were in a bear trend until you cross back above here. You get the picture, right? So bearish cross, drop. Bullish cross, you want to be long. And so, and it also, that line acts as support on pullbacks. So you pulled back, but you never crossed over. You bounced. And right here, we're there. So that, if we can reverse here, that keeps this trend indicator has been bullish since this point. If you were going just trading solely off that, it said buy long, go long Nvidia, and be long until this crosses back over. So that's it. So you have, support on that indicator as well. And that's why I cannot and will not eliminate, still a decent chance of that marginal new high scenario until we start to get additional sell signals such as breaks of these support levels, trend indicators flipping bearish, etc., etc., etc. Tesla at support. Let's see the 60-minute chart, what it tells us, not much. Meta, nothing much on the 60 to note. Daily chart, need my lines to populate here. There they go. Still holding above that August 18th low. Kind of a blah, meh chart. I don't see a whole lot here, but I do maintain these longer term targets. Again, if the market bounces, Apple and those other ones, if they step in and buy those have better charts. Obviously, the ones I just told you at support, like Apple, I'd be going long Apple before I'd be going long Meta. This one will probably underperform in my opinion. But I still maintain these targets, even these potential targets down here. To me, it's just a matter, are we going to get a little bounce first? Maybe even a marginal new high and then do it? Or we're just going to crap out? Again, one potential catalyst, like I said, could be tomorrow, GDP and unemployment numbers. Okay, let's stop it here. No reason to beat a dead horse. Most important things I'm watching: interest rates, 10-year Treasury yield. You can look at all the 5-year, the 30-year, but just, if you want to keep it simple, track the 10-year. Crude oil prices, and they will, if you are bullish and you're liking these divergences and these support levels I showed you, and you think there's that chance for new highs, I can tell you the odds are much lower if crude oil continues to rally. I would be very surprised to see the market making new highs, over these previous highs here. We're not, this one's still well off the all-time highs. I'm talking about the highs from back in July. Unlikely unless crude oil and treasury yields start to abate. Oh, I have one more thing to show you before I wrap up here. The euro US dollar. So my weekly chart actually looks the best. Okay, every now and then I loop to the big picture on the euro, which is my weekly chart here. And for quite some time, I've showed you this big bearish rising wedge on the weekly right here. And it broke down, and I expected the drop in the euro. And look at this. I've had this level here forever, this major long-term support. I call it support/resistance zone because it was support, and then we broke it. I figured it would most likely prove to be a false breakdown, bear trap, and we did. We recovered it, and that was bullish, and that gave us this rally here. Remember, the euro and the stock market here. I always say don't take my word for it. Just when I tell you these things, check it out yourself. Put up overlay the S&P 500. They're positively correlated. They go up and down together. When the euro's rallying, that's these candlesticks, the S&P is rallying. When the euro peaked right here pretty much, double top. The S&P didn't get the memo right away. It made a little bit marginal new high and then followed it down almost in lockstep. You had a little kickback rally in the euro there. The S&P followed. Then that went down to new lows. So did the S&P right there. They both bottomed in October of 2022. Dead on. Both perfect bottoms. And they've rallied since. So if you want to know where the stock market's going, you just have to predict correctly where the euro's going. Or the dollar, it's inverse to the dollar. If you want to use a dollar, just put the dollar upside down. And that's it. So I wanted to share that one with you and point out and say that this would help support the case for the marginal new highs going to the weekly chart, that we are at pretty good support. It's the top of my support zone. And remember, I had this support zone created. This line here was created back on May 23rd, 2022. So right here, I created the line here, and you can see it's still just as valid. This is where we broke out above it. We back tested it right here, and then we had multiple back tests, 4 weeks in a row. Every candle perfectly back tested that line. And again, the line was created back here. So it shows to me it's technically valid. So you have the euro at support. And the initial tag, also, let's see what that wedge measurement was. You take the widest part of a wedge to get a rough measurement, measured target, add it to where the wedge breaks down. Well, that would, see, the breakdown would have us going to the bottom of the zone. And that's how it works, guys. We don't have to bounce here, but it is support, and there's a decent chance. If not, we drop, the next support's down here. And then I'll be talking about this maybe a week, 2 weeks, a month from now, if the euro's there at support. Daily chart, all I can tell you is we're just very overbought. We keep hitting these extreme, and this is an extreme overbought reading. The last time we were this overbought, I'm talking about the RSI down here, you got to go all the way back. If I grab right here, nope, right about here, and that proved to be the bottom, a major bottom in the euro that gave us that. So hence the reason for my kind of caution right now on the short side, and openness to the fact that we could rally here. But as I said, and I said yesterday, I don't think it's double speak or wishy-washy analysis. If it's all break, if support breaks and the euro goes down to the next level, if the support breaks on Apple and Alphabet and everything I just showed you, and we solidly break down through there, then we're probably going down to the next support levels. And then the bounce is going to come at lower levels. So, and then I'll adjust accordingly. So hopefully that makes sense. Let me get the video out to you guys, and I'll let you decide how to play it. This has been Randy Finney with Right Side of the Chart. Have a great day.